Today, folks, I am seeing something incredibly peculiar happen right now between not only major investors, but smaller investors as well. We are seeing a split as everyone is starting to change up their strategies. I mean, we're going to compare the titans, the juggernauts that are Warren Buffett versus Ray Dalio. And trust me, they have been doing some pretty odd things. And then we're going to even boil it down to, from Blossom himself, Brandon Beavis, for many of you Canadian investors out there, is a guy that I follow, and he recently updated a major pivotal shift to his own portfolio. And then I want to do the comparables on stocks that I honestly think are huge buying opportunities today, especially heading into some of their earnings. And this is that kind of discussion, whether is it worth buying tech now on the dip? Obviously tech is the future, or should you start taking advantage of the interest rate recovery plays, as I've done to some extent with some of my real estate ETFs and so much more. And as a treat to you guys tomorrow, to give you full clerical idea into my investing strategy, I'm going to share with you the combined portfolios of mine and my fiance's on tomorrow's live stream. So consider subscribing for that. We usually do 9 p.m. Eastern on Sundays. But getting into it, the portfolio first and foremost has recovered a nice little chunk here. I mean, I think at the peak I was down just probably about 20,000, and now we're starting to recover quite nicely with the rest of the market after the flash crash caused by Japan. But I don't know what it is with this market and what it is with these macro events, but it has caused some massive shifting within these mega investor portfolios. Now, I found this to be the most intriguing because Ray Dalio, if you guys don't know him, go do some research on this guy. He has just written and posted some of the most incredible stuff, but he's really pivoted into tech in a way that kind of surprised me, because he was more or less a very conservative investor with a vast majority of his investments sitting in with broad-based ETFs. But now really, like, I mean, the SPY used to be one of his largest positions, but now his largest positions in here, he's really increased his shares in Google, Nvidia as of recently, Meta. I mean, he picked up 3 huge tech companies and even started buying Apple during a time where many of you know Warren Buffett has actually been selling. And if we take a look at his performance history here, and this only goes to Q1 of 2024, I'd be very excited to see where this goes moving forward. And this doesn't really take into consideration, obviously, the updates he's been doing, but his performance leading into the first quarter was great, right? So I'm very intrigued with these recent ads, when he actually got into them, because obviously we only get the quarterly updates, but he only recently just really built a Google position. Nvidia, hopefully not at the top of the market before that 20% correction, added a huge percentage to Meta. This is really fascinating, because typically he was more of a consumer defensive kind of player, with Costco and Walmart, Pepsi. So it's crazy to see him taking on such a heavy tech position, even added a huge percentage to Microsoft here as well. And I'm saying that because in contrast, like, I always thought Warren Buffett was the more aggressive tech investor, because he took a huge percentage of his portfolio and just dumped it all into Apple, which takes a lot of cojones. But Warren Buffett these days really is shedding a light on his, I don't know if it's his timidness, his fearfulness of the, hyperinflated market maybe, or what the deal is. But for him to sell off 50% of Apple, to me, absolutely blows my mind. So I mean, he liquidated Apple by 49%, which kind of takes into consideration Ray Dalio is probably picking some of those shares up, keeping it a little bit more level. Now, I obviously think Apple is quite valued here. It has not begun to justify the extreme premiums that it is currently trading at, and I think there's a correctional period potentially down the road for Apple, but that does not mean it's not a long-term hold still, right? Like, I still think it has huge long-term potential here. And for a guy that when he bought it said he'd rather own more of it and hold on to it forever, and even up to last year, I think, was just buying shares of the company, I'm like super perplexed on why. Like, why sell? Why? I think he's got like a quarter, I think 270 billion or something in cash right now, with his next biggest positions being Bank of America, American Express, which is a great company, Coca-Cola, like oil giants, which Occidental. I just find these holdings so odd in this kind of technological revolution that's been going on, and how much returns tech companies have offered. He just never takes the opportunity to buy them ever. And I just find it so odd, because again, Google seems cheap. I love Meta stock, and I can't, like, I'm not saying I'm as great as Warren Buffett, but you got to recognize that these things have moats now. I mean, almost 1/3 of the world is using Meta, and it is still growing. It's like, I'm just saying. Now, switching over to the Canadian influencer side of things with Brandon Beavis. If you don't know him, he's kind of a smaller influencer that I've been following, all big in the Canadian world of things. And he recently actually did something I think most Canadians, most investors in general, will eventually boil down to doing. It's something that I did because I think at scale, when you get into the hundreds of thousands of dollars, there's just no way to properly manage an individual stock portfolio without taking on too much risk. And we're even seeing that in the likes of Ray Dalio's portfolio. Heck, even Warren Buffett does this to some extent. But honestly, quite a bittersweet feeling today. Oh my goodness, that's way too zoomed in, but I'm excited to share an update on the portfolio. I opted for a combo of VOO and XEQT. Understanding there's an overlap on the S&P is totally okay with me, plus getting a bit of TSX international and emerging market exposure. I'm happy with this mix. This is my RSP, by the way, which has both USD and CAD inside. Mine's all USD, but I had approximately 130K in cash, and I chose to invest about 70% of it. 70% of it, and I'll plan to deploy the rest into these same funds in the near future. Now, my TFSA is also en route to basically be in Wealth Simple, just to have all my accounts in one place, which I don't think is a smart idea. But sorry for the confusion caused by my recent trade. I had one share of VFE kicking around in my brokerage account, so it showed up as I sold the entire position. I promise it's not as bad as it looks. Now, the reason and the only kind of pick that I have is I am a paranoid nut job, especially with CrowdStrike going down, making it like a lot of banks to some extent weren't even usable. I literally also am fearful banks will eventually, or maybe not eventually, but there's always the risk they could go bankrupt, and there's only so much insurance on your cash. Your investments are usually pretty safe. However, I put my money in Royal Bank, TD, Bank of Nova Scotia, Canadian Imperial. I mean, if I show you guys the disgusting amount of cards that I use here, which I don't want to show you the numbers, but I use a disgusting amount of cards from a bunch of different banks. Like, it's very hilarious. But nonetheless, I really think this is the more wise thing to do. Really just boiling the portfolio down to a couple simple investments that you can just make month over month and cost average into. Now, for me, my strategies continue to be invest mostly in ETFs, a handful of them, maybe like 3 or 4 of them, and then start picking individual stocks that I can mess around with and pay more attention to try and outperform. Now, that is working greatly to my favor. I mean, we're outperforming this year thanks to the performance of Google and Tesla, and I'm looking at having this perplexing is my new favorite word apparently, but I'm looking at it either getting back into tech because some of it's looking really favorable again, or again, continuing to cost average, which I'll probably do into some of the interest rate recovery plays, because those are the 2 real plays going on right now. When tech gets cheap enough, it's always a buy. But right now we're looking at the interest rate cut cycle coming, and there's a lot of big dividend players that are coming at the discount. But I want to talk about 2 tech companies specifically right now, which is going to be Google and Nvidia, because both of these are utterly fascinating right now, especially with Nvidia's earnings coming up. Now, I'm not saying Google's trading at a cheap value, but for the growth that it currently has, it is trading at a favorable value. It's actually below where I sold out of it at, and I still have fear that they could have some risk because obviously the government just stepped in and said they were a monopoly. They were using monopolistic behavior to compete and buy into, Apple to be the number 1 search, default search browser on all Apple devices. And we don't know what that fine could lead to or how detrimental it can be. There's a lot of headwind risk here, but I think some of that's been priced in because the right price, even for that risk, Google could be a great buying opportunity here, right? And, like I said, when it goes back below where I was buying it before, I get kind of intrigued considering the revenue is trading at about 15%. And even on the last quarter, we had 15% rev growth. It looks like we're heading toward $100 billion in revenue if this keeps up, which is absolutely jaw-dropping. And again, when you look at that price to earnings multiple here on the price ratios, it's not often. There's only been a couple times in history where Google dips below that 23 mark, to be honest. There was 2022 when that big kind of crash happened, but throughout its entire history, it's always been trading above a 25 times multiple. So I'm looking at this as still being pretty favorable right now. Again, there's always the headwind risk of search starts getting a little bit more absorbed by, ChatGPT and Meta's, and even Twitter's X's, Grok right now. I mean, that could start stealing some search traffic for people looking up stuff. But right now, you got to admit, it is a growth beast from 42 billion to 48 on a year-over-year is quite incredible growth here. And YouTube for sure, right? I wish YouTube was just bigger. I wish it was just bigger, man. YouTube would be awesome if it was a bigger. It is a good growth beast, but I just wish it was more contributing to the revenue. However, on the pivotal side here, Nvidia could also be. Nvidia's heading into this this really interesting phase. And a lot of people, I don't think, understand that this could almost be a great earnings trade right now, because not only is it corrected by 22%, it's trading back down into the 60% range. But I think this has a lot to do with a couple factors. The fact that their growth is starting to slow down a bit. And when I mean slow down, they're having to deal with the scale of large numbers, right? Because they're showing the revenue expected, and I'm looking at guidance because they've always beaten guidance. But if they can beat this guidance and it's trading down to where it's trading down, could be a good buying opportunity because revenue is expected to be 28 billion plus or minus 2%. Q1 was 26 billion, which was an absurd growth rate. I mean, 18% quarter over quarter. But again, it's slowing down because from 22 billion to 26 is, a bigger jump than 26 is going to be to 28. And they're also expecting their gross margin to go down a bit too, which I find odd because their gross margin's at 78%. So I'm surprised they're guiding for lower gross margin. But my guess is, they're going to beat the shit out of this because that's what they do. And when you take a look at their actual, again, price to earnings multiples here, they're back down in the 60s, right? Considering they were up in the hundreds there. And the 60s is below where it was, at some of the growth that it started getting into in 2022. And if it continues to beat those earnings, I'm saying it could be a good trade. However, I want to see it beat, hopefully up toward the 10% range, because again, we're seeing it go from 30% beat down to 9%, and it continues to slowly wean its way in, dealing with the law of large numbers. But again, these are beats, right? This is how much they're beating by analyst expectations. So I'm looking at this too, and I don't usually do earnings trades, but when it's trading down this much, and I have a hard time believing that they're not still selling a crap ton of GPUs. I don't know, man. I'm not much of a short-term trader, but you got to look at this being like, Ray Dalio's been buying into it. I don't know if he was buying into it at the good time, but again, there's some opportunity here, folks. Lots of opportunity in tech right now. There's lots of opportunity in interest rate recovery plays. And what I'm going to do, well, you're going to have to subscribe. You're going to have to continue to follow. And I'd love to know what you're doing with your portfolio in that comment section below.